Chapter 7, Cash and Receivables. From Intermediate Accounting, KESO 16th edition. Cash and cash equivalents. This is shown on the balance sheet. Well, what is included in that? Well, of course, it includes the cash, which is the most liquid. And since it says cash and cash equivalents, it would include short-term investments that are highly liquid and easily converted to cash, usually called trading securities. That's what, and again, these would not be like 3 months. These would be like maybe they just park cash there over the weekend. Restricted cash is restricted from regular cash and is set aside. So that would not be included as part of the cash. And then bank overdrafts. The rule is, if you have a negative balance in your bank account, but you have another account in the same bank with a positive, you can net them two together. But if they're not in the same bank, then what you have to do is show the bank overdraft as a current liability. Now, we talk about discounts. One of the things we talk about is a trade discount. When we talk about a trade discount, what we're talking about here is if you look in a catalog and they say it's $100 if you buy one, but it's $20 if you buy 10. We ignore that. We just book what we paid for them. Sales discounts are different. This is a contra sales account, and this is what we do when people pay early. And there are two methods. One method is the gross method. We record the gross sale and record the discount only if it's taken as a debit to sales discounts. The net method is we book the sale net of the discount and only credit sales discounts forfeited when the discount is not taken. So now we'll look through example and I'll show you what that looks for both of these methods. So say we had a sale of $5,000 with terms 3%. If they pay in 10 days, they have to pay the balance in 30. So for the gross method, we would record the whole $5,000. And if they paid within terms, we would then show the sales discount. And we take the whole accounts receivable off the books, but the cash would only be $48.50 because they took the discount. Now, what happens if they paid after 10 days? Well, in that case, we would just record the cash and the accounts receivable. Now, what does this look like under the net method? Under the net method, we would only record the $48.50 or the amount of the sale less the discount. And if they paid within terms, it would be the cash and offset the receivable. If they didn't pay within terms, then what we would do is debit accounts receivable and credit our account called sales discount forfeited. And then we would book cash accounts receivable. Now, accounts receivable itself, we know that we're not going to collect all our money, and there are two ways of handling uncollectible accounts. First is the direct write-off method. This is not acceptable under GAAP, but is required for tax purposes. What we do here is we only expense bad debt when we actually incur bad debt. And then we have the allowance method. In the allowance method, we set up a contra account called allowance for doubtfuls, and we estimate how much we don't think we're going to collect using the percentage of receivables method. We can either use one rate or we can actually age our receivables using different rates. And the rule usually is the older the account, the less likely we're going to collect it. Now, the good news for you in covering this chapter is we no longer, under general accepted principles, according to KESO, we no longer use percentage of sales, so we're not even going to cover that, which makes this a lot easier. Okay, so here's our first example. If we had bad debt expense that we're estimating at 4% of gross accounts receivable, and you have a debit balance in the allowance for doubtfuls account, what is our estimate for bad debt expense? Well, first of all, what we have to do is determine the ending balance for allowance for doubtfuls. We know the ending balance should be $3,600. That's what it's telling us. We're saying that's how much we should have. We also know that we have already a debit balance of $1,750, which means to get it up to $3,600, we're going to have to book bad debt expense of $53.50. And if you put that in the T account, if we take $1,750 5350 minus the 1750, we now get the 3600, which we're saying should be the ending balance in allowance for doubtfuls. Now, what happens if instead we currently have a credit balance in allowance for doubtfuls? Well, we're going to start with what our ending balance should be. Again, it should be 3600, but in this case, we have to subtract out the 1700 that's already there, and so our bad debt expense to get us up to 3600 is going to be 1900. So we're going to debit bad debt expense and credit allowance for doubtfuls, which gives us the 3600 that we desire. Now, what about notes receivable? So let's look at this example. In December 31st of 2017, Mike renders services for Danny Corporation at agreed on price of $122.55, accepting $50,000 and agreeing to accept the balance in 3 equal installments of $30,000, receivable at the end of each year, and we should assume that has an imputed rate of 12%. So what we're going to do is record, and we're going to use the effective interest rate to amortize. So December, to determine the initial transaction on December 31st would be cash. We receive cash of $50,000. We have notes receivable of $90,000. We have service revenue of $122.55. And we have a discounted notes receivable, which is $17,945, which is really interest revenue. The discounted notes in this example is a plug because they already told us the value of the services. If they hadn't told us that, what we would do is we would go to our present value of an annuity. We would go across to 3 years, 3 periods, because it's only one payment each year, and over to 12%, and we take the factor times 30,000 plus the initial payment, and we end up with that same $122.55. Now again, the $17,945 is interest revenue, but since we do accrual accounting, we have to allocate it over the 3 years. So now let's do an amortization table so we know what each $30,000 payment is going to be made of a reduction of the carrying amount of the note, and a portion of that would be recorded as interest revenue. So the first payment is all going to go, because no interest would have accrued, is all going to go against the amount of the note. So it's the $122,055 minus that $50,000 payment, and now we have $72.55 on the book at the beginning of our first year. Now what we're going to do is we're going to get our first payment of $30,000, and now we're going to figure out how much of that $30,000 is interest and how much is principal. So what we're going to do is take the $72,055 times 12%, which means of that $30,000, $86,4660 is going to go for interest revenue, and $21,353.40 is going to be subtracted from the $72,055 to tell us what the carrying amount is going to be for the note. The next year, we're going to do the same thing. We're going to get the $30,000, and we're going to take the balance of $50,701, and we're going to take that times 12%, and that tells us of that payment, $6,084.19 is going to go to interest, and the balance is going to go against the note. And then in the last year, it's going to be a plug, and it's going to be the $30,000 minus the carrying amount tells us that $32,1421 is going to be interest revenue, and the balance is going to go against the principal. So now we can do the journal entries. For the first year, first payment, the cash is going to be $30,000. The notes receivable is going to be $30,000, and then we're going to amortize that discounted note and book $86,4660 as interest revenue. In the next year, we're going to do the same thing, but now we're going to have interest revenue as $60,84.19 from our amortization table. And then in the last year, we're going to take our last payment and amortize the discount on note, which would bring that to 0, and our notes receivable should be 0. And we are finished with that transaction. And that's how you handle accounts receivable, setting up your allowance account, and recording a notes receivable.